like to waste a lot of time, so I brought my whole panel on at once because we have so much to get to. I am delighted that Bob has successfully reframed accountants as superheroes, because we are now going to talk about an adjacent superhero, your corporate treasurer. So I'm excited to welcome Nimerta, Paul, and Joanna. I'm going to have each of them give you a little bit of introduction about themselves in the guise of my first question. So Paul, let's set up, if you don't mind, in the context of Topo Finance, sure, the opportunity that we're talking about here. It's been described as a superpower. I think Bill McKibben said that it wrote an entire New Yorker article on the impact that corporate treasury can have. There was a session about this, I know, earlier today, so some of you may be familiar, but let's dig in anyway. Tell us what you're working on.
Yeah, thanks, Molly. So historically, corporate treasury has been very much outside the purview of the Corporate Sustainability Office and the climate initiatives of companies. But in 2021, we just started asking the question. If you remember at that time, a lot of companies were really ramping up their environmental commitments. Their net zero commitments were getting more aggressive. They were reporting more. But we would look through these reports, and we wouldn't see anything in there about banking and investing. And we just sort of started asking the question, like, if Bill McKibben is telling me that Paul, and I have like no money because I run a nonprofit organization, that where I bank matters, what does that mean for the largest companies in the world, your Apples, Googles, Metas, et cetera? And so we set out on a research project, and essentially what we found was that for the largest companies in the world, their banking and investing actually generates more emissions than everything else they're doing combined, scope 1, 2, and 3. And when we started talking to companies, we learned that they, frankly, really didn't know what we were talking about. And so our data person, who's the former CFO of Sustainable Finance at HSBC, always, whenever we come up with data, she's always like, well, so what? What does this tell you? And so we had this really interesting moment where we realized that this was not only this huge source of emissions, but an incredible opportunity for climate leadership and climate influence that climate-leading companies were not embracing. And you know, if you take a company like Microsoft, which is a great climate-leading company, is doing tremendous work, they've got a $1 billion climate innovation fund that's investing in new and exciting technologies. But meanwhile, they've got a $120 billion climate devastation fund called their corporate treasury, which is generating more emissions than everything else the company is doing combined mostly. And so what we do now as a nonprofit is we continue to conduct this pioneering research, but we are super fortunate to work with incredible companies like Seventh Generation and Unilever and many others to help advise them on how to transform their banking and investing from their largest climate driver into their most powerful vehicle for driving climate progress.
Before I move on to Joanna, put a fine point on it if you wouldn't mind. I'm sure that this is a sophisticated audience, but if you draw that bright line from the money to the climate emissions.
Mm-hmm. In terms of
where you bank and why it generates emissions that offset all of your good work.
Yeah, and so you know, cash just doesn't sit in a bank account. When you put it in a bank, banks lend it out across the economy. And for the largest banks in the United States, about 20 to 30% of all of the money they're lending out is going to the world's most carbon-intensive sectors. And so it is generating a massive amount of emissions. For banks, they're, according to a study that CDP did, their lending and investing is generating 700 times more emissions than everything else they're doing. Our research has shown that the largest banks and asset managers in the United States, if they were a country, would be the third largest emitting country in the world, and that cumulatively corporate cash in the US, which is about $7 trillion, it represents about 20% of all emissions in the US in terms of the amount of emissions that money that companies hold in cash and other investments is generating.
There we go. All right, now that Paul has dropped the bombs explicitly for us. Joanna, let's talk about your role in this as someone who started doing this and then just, you know, went ahead and transformed this industry and created some products so that other people could do it. You've taken both a dual role as a group treasurer, but also someone who's tried to push these practices forward.
Yeah. Thank you for having me. So I am a group treasurer. I was also a CSO for a multinational in the UK. I'm president, or immediate past president, sorry, of the Association of Corporate Treasurers, and one of my additional roles is sitting on the UK government board for the Transition Finance Market Review, making sure that we've got equality and regulation within this space. As a group treasurer, I started investing in sustainable products about 5 years ago, but it was before the market was ready. It was before we were able to actually account for it. So what I knew as Group Treasurer and CSO, that we needed to invest our excess cash into products. And so within the UK market, we worked with our banking providers to set up the first sustainability money market funds and also green deposits.
Amazing. And then Nimerta, tell us about your role at Seventh Generation. You're going to see a lot of Nimerta today. She's the hardest working woman at Greenfin. 3 panels in one day. Tell us again about your role at Seventh Generation and how tactically you are actually instituting some of these treasury practices.
Yeah, so I am Nimerta Sirichand. I am the CFO for Seventh Generation. For some of you that might not know the company, it's a consumer goods product manufacturer and has been in the green space, making sustainable products since late 1980s. And sustainability reporting is not new for Seventh Generation. So Seventh Generation was a pioneer in sustainability reporting, started it for the first time in the year 2004, and has been issuing annual sustainability reports around their carbon emissions that strictly come from operations since then. What's different now, and more recently in year 2022, which was about 2 years back, we really came to realization as a company that we need to extend the scope of the CSR reporting outside of Scope 1 and Scope 2, which is essentially the emissions that come from our operations, to really expand the horizon and include the emissions that come from ancillary services, including our banking practices, our 401k plans, our insurance deposits, as well as any of the marketing agencies we work with. So we really expanded how we define our impact on the climate beyond our operations. And in that space, we have partnered with Topo, that Paul leads, to understand what our impact is beyond our operations. The interesting thing that came as we kind of went on this journey is we realized Seventh Generation is a fully owned subsidiary of Unilever, and we were acquired by Unilever in 2016. And we said, well, wait a second, if I need to understand what my carbon emissions are from my cash holdings, I can't do it without Unilever's partnership because we don't have a balance sheet of our own. We are fully integrated with Unilever. So we are now really talking about not just Seventh Generation's carbon emissions from its cash holdings, but we are talking about Unilever's impact to the environment from how it manages its banking practices. So the scope all of a sudden became much, much broader. But with the help of Paul, who helped us kind of put together a methodology to truly quantify what that impact is from strictly our cash holdings. And to go a little bit more into that methodology, we looked at at the end of 2023, we looked at our year-end balances across 6 major banks, some European, some based in US, given our global footprint as a company as Unilever. We looked at what their lending practices are. So we looked at their lending portfolios and what their carbon emissions are per $1 million, for example, of their lending portfolio, and used that to extrapolate what Unilever's impact is from those deposits with those banks. So for the first time ever, we were able to quantify the impact of our cash holdings, which I think was a huge step forward in this journey of reporting our CSR impact.
Talk a little bit, Joanna and Paul, if you would. Joanna, I'll just start with you, about how the two of you work together, too. We should say, this is an interconnected panel in some ways. It is both a practice and a movement.
We're yet to work together, so I can say that I'm completely independent here, but I'm about to start with a new multinational that will be based in Switzerland, and we'll be working together through accounting, very similar, the journey that you've gone on. I want to understand the carbon emissions attached to the investment portfolio. The banks that I'm about to work with, they're already aware that I'm about to transition the portfolios to sustainable products going forward. But I wish Paul and his company were with me on the journey 5 years ago, because there were only a couple of us in that space at that point in time, and we weren't able to even comprehend the actual carbon accounting. We were just after the products. What's the sort of the principles and the ethos behind and the intent behind of what we were doing?
Right. It does seem like there are these kind of key parts, right? There's the actual accounting, which has to be accurate and metrics-based, and then there is the understanding of the problem. Is that fair?
Yeah, I mean, when we set out, we sort of mapped out 4 kind of enabling factors that we knew that we needed to hit, and we've actually since added a 5th, which has been an interesting development. But it's really awareness, like you can't work on something unless you know it exists. And then you needed the data and the tools to actually measure this stuff. And then you needed the strategies and solutions in order to actually be able to have an approach where you're having an impact. And then finally, you need sort of forcing functions of, one of the things that this is not currently in the GHG protocol, but we have been talking to them, and we know sort of quietly been told that like this is part of Scope 3 Category 15, but it's never been required because the data and methodology hasn't existed. And so having entities like that recognize that, it creates a powerful forcing function. And then the last thing that we added recently to this sort of enabling factors is actually proof points, because companies like to go together. Very few companies like to go alone. And so it's been incredibly valuable for us to be able to learn from Joanna and the work that she's done, pioneering work that Patagonia has done, and now with examples of Unilever and 7th Generation, like we're starting to see what started as there were a few companies that were doing this because they had a gut feeling that this is what they should be doing, to now a really data-driven approach where you have leading Fortune 500 companies around the world that are really starting to take action in this, to the point where we expect it'll soon become standard practice to do this. But you have to have those things in place, otherwise people are just, nobody likes to be told they have a problem that they can't solve.
Right. I want to ask about the business case, harkening back to Grant saying that the job of a corporation is what keeps a company rich, what keeps it poor, and everything else is in between. Email, love that. God help us from email. What is it? Can we quantify email as an emissions problem? I think that could solve a lot of things for all of us. Joanna, I'm going to ask each of you this, but I'll start with Joanna. What is the business case for this, for these companies who are sort of new on this journey but need to get there?
So for us, it was really hard to quantify.
Yeah.
We're talking pre-pandemic, just as these products were being launched. We also needed to make sure that we had enough seed capital in each of the money market funds with the banks to reduce our exposure as a treasurer and as a corporate from a counterparty risk perspective. So it took a while to get these products in. So the business case for us was about the principles and the ethos behind our intent, and that's what we took up to the board. We did not take a numeric, a traditional business case.
Right. As in, it may not save you money or make you money as a company
that point, it was,
at first.
At that point, 5 years ago,
right.
It was very hard to quantify. And we certainly used our might with the banks to make sure that we didn't have a price penalty attached to this. My wording was, you want to penalise me to help the environment. I'm not sure how I can sell this to my board. They were very keen to get these products launched, so we didn't have to pay a penalty. I think the landscape has changed, particularly in Europe. These are more commonplace, but at Page Group, my previous employer, we actually had a mandate from the board to only invest in green and sustainable products. So again, it's a journey.
Nimerta, what are you finding in terms of the business case and the cost parity of these investment vehicles?
It's difficult. The business case is difficult to make to your board members, but I think a couple of things. It's not a short-term business case. It's not like I can pay this back in 2 years. We do believe, though, that this kind of methodology where you extend your emission reporting beyond your operations to how you manage your cash investments creates a more of a level playing field in whatever industry you are. Let's say we are in CPG. We do believe that it allows us to create a more level playing field, because then you are talking to other like-minded companies in the CPG sector, and if they all follow the same practices, you create more of a chain reaction. I think one other thing we learned from Topo, because Topo was our advisor as we worked through it, is that if you keep the focus really narrow on your operational emissions, you're putting in all this effort to create really green products, right? So we source PCR. Most of our products are made with recycled plastic. We also make it with biodegradable components. So on one end, all of this effort that you're putting in to create really green products for the planet and the consumer really cares about it. On the other hand, the cash that you generate from these products then go into a cash management account that then goes and then fuels all the same things that you don't want it to,
Right.
then you've not really solved the problem, right? So you may not be able to see the business case in the moment, but over the long run, this will allow you to create a more of a level playing field.
Particularly when you've got other data, so maybe not just the numbers, as in financial numbers. If you're talking about the business case for carbon accounting now, with Topo, you do have that business case to be able to say, right, my emissions were X, they are now Y.
Right.
So that's one thing that helps. I also think that there's a very strong employee value proposition business case, particularly the men at my millennial employee base previously. They were very, very interested to know where their pension funds were invested. So again, there was a business case for employee satisfaction, and that can come through in numbers, but not necessarily the hard numbers that maybe a CFO or a board would want to see.
Right.
Yeah, and I think one thing to just add quickly is that we try to get companies just to think about their banks as another supply chain partner. And so what corporate sustainability officers do is their job is they go out and they work with all of their supply chain partners and they engage with them to understand what their policies are and what their practices are. And we think of banks as no different. And it doesn't cost you any money and it doesn't take very much time for you to pick up the phone and set up a meeting with your banks to actually talk to them about their climate policies and practices. And so there are versions of this where you can have a huge systemic impact on the banking system because banks like to hear from their customers and their clients, and it's critically important that companies are engaging with their banks about this to send a very powerful demand signal, and that part of this is free. And I'm reticent to speak on his behalf because he is not here, but I've heard him say this now enough on panels where I feel comfortable saying that Charlie Bischoff, who's the treasurer of Patagonia, will tell you that he's actually made money by doing this because it's forced them to think more innovatively about how they're managing their money, and that by looking at things and not accepting the status quo and by being able to embrace some new fintech solutions and other things, they haven't fully accomplished what they're hoping to from a decarbonization standpoint, but they've made major strides on that and actually made money at the same time.
And at the very heart of the Treasury team, this allows perhaps more ethical and green motivated employees, so the actual morale in the Treasury team spikes.
Absolutely.
Absolutely.
Right. And not for nothing, it is something that you can accomplish relatively efficiently. It sounds relatively quickly compared to overhauling the rest of your supply chain or procuring a bunch of new technology. I'm going to ask one wrap-up question quickly of you all, but I do want to firmly say that another business case is that nobody's cracked Scope 3, and this is Scope 3. Right?
Yeah, and the point there that's super important, and thank you for bringing that up, is that in order for companies to meet their Scope 3 emissions, we have to decarbonize the financial sector because they are the ones that are shaping a lot of emissions throughout the economy, through the energy sector and everything else. And so for companies that care about Scope 3, working on their banking, which is not only should and at some point will likely be part of Scope 3, but will help companies achieve all of their other Scope 3 goals when it comes to the operations of their products.
Amazing. All right, I'm glad we put that fine point on because we are now out of time, but call your accountant and call your treasurer. It turns out there are superheroes in unexpected offices. Thank you so much, everyone, for the time.
Thank you.